Welcome to Talk Tickers.
Hey there.
We are your professional earnings call summarization podcast. But on this deep dive, you are exploring a deeply interesting financial topic that is really reshaping retail investing.
It definitely is.
Yeah, so imagine standing in the middle of a chaotic, high-stakes casino. You spot the one person in the room who seems to be on just the most incredible, unstoppable winning streak of the night.
Right, the guy who can't lose.
Exactly.
Yeah.
Now imagine walking up to that total stranger, handing them your wallet and saying, whatever you bet on, just place the exact same bet for me.
Which sounds completely insane.
It sounds completely insane, right?
Yeah.
But today, through a system known as copy trading, millions of retail investors are doing exactly that with their life savings.
Yeah, every single day.
Copy trading is a system that allows you to automatically mirror the market moves of seasoned traders. It is fundamentally changing how retail capital interacts with global markets.
And, the promise here is massive.
Right. It claims to democratize finance by letting anyone, regardless of their financial literacy, just piggyback on professional expertise without spending a single hour analyzing complex charts.
So to start with the summary, and the summary is basically this. It looks like free money.
Exactly. It looks like free money. But what happens when you strip away that beautifully designed, user-friendly interface?
That's where it gets scary.
You uncover a highly complex web of hidden fees, extreme leverage risks, and subtle behavioral traps that can turn a seemingly passive income stream into a rapid portfolio liquidation.
A total wipeout.
So our mission today is to unpack the actual engine running these platforms. We're going to break down the specific fee structures that are quietly eating into your profits. We're going to expose the psychological illusions of risk that these apps are built on, and we will look at the sweeping regulatory changes forcing these platforms to rethink how they operate.
Yeah, it is a truly fascinating landscape. And honestly, the stakes could not be higher for the average retail investor.
Oh, absolutely.
I mean, we are looking at a system that essentially removes all of the traditional barriers to entry for highly complex financial markets. But in doing so, it introduces entirely new categories of systemic market risk and, deeply personal financial danger.
Right.
If you do not understand the mechanics under the hood, you are flying completely blind.
Okay, so let's unpack this by starting with the absolute basics, because I think there is a massive amount of confusion out there for anyone just stepping into this space.
Oh, for sure. The marketing is very confusing.
Yeah, you hear these buzzwords thrown around interchangeably all the time on social media and in financial ads, like copy trading, mirror trading, and social trading. But if you actually look at the mechanics, they are not the same thing at all, are they?
They are definitely not. And treating them as if they are the same thing is like the very first major mistake a new investor makes.
Okay, so break them down for us.
It is absolutely crucial to define this landscape precisely because the underlying mechanics of each of those three categories fundamentally alter your financial risk exposure.
Right. Let's start with the broadest one.
Yeah, let's start with social trading. This is the broadest and really the oldest category of the three. Think of it as a highly specialized financial social network.
Like a Twitter for finance.
Exactly. It looks and feels a lot like Twitter or Reddit, but it is entirely focused on the markets. It incorporates forums, chat rooms, community sentiment gauges, and shared research.
Okay, so I'm logging on and just seeing what people are talking about.
Right. You might log on and see what a prominent trader is thinking. You might see a chart they posted or read their rationale for why they think, say, the euro is going to drop against the dollar.
Gotcha.
But, and this is the key distinction, the platform is just an information hub.
Right. There's no action happening automatically.
Exactly. You still have to absorb that information, open up your own separate brokerage account, and manually execute the trade yourself.
Right. So social trading is just sharing ideas. It's an interactive message board. There's no automatic money movement happening. If I see a great idea, I still have to physically push the button to buy.
Exactly. The friction of execution is entirely on your shoulders.
Okay, that makes sense. So what's the next level?
Then we step up a level of automation to mirror trading. This is where the technology starts to take over, but you are not copying a specific human being.
Oh, interesting. So what are you copying?
In mirror trading, you are copying a specific algorithm or an automated quantitative strategy.
Like a trading bot.
Essentially, yes. You log into a platform, you look at the parameters of a specific trading software. Maybe it's an algorithm designed to, buy tech stocks whenever they drop 2% in a single hour.
Okay.
You look at its historical performance and you allocate funds to it. From that moment on, your account automatically mirrors the trades generated by that specific computer code.
So it's totally emotionless.
Right. There is no human intuition involved in the day-to-day trading.
Which is very different from betting on a person. And that brings us to the core of what we're dissecting today, right? Copy trading.
Yes. Copy trading is the automatic, direct replication of a specific human trader's moves.
Okay, human being, the key word there.
Exactly. You are linking your financial account directly to another individual's account via the platform's API or application programming interface.
Right, a digital tether.
It is a digital tether. When the human trader you are following clicks buy on their computer, your account automatically buys. When they panic and click sell, your account automatically sells.
Wow.
And the core mechanisms making this frictionless experience happen are account linking, signal following, and real-time execution.
Okay, let's drill down into that real-time copying mechanism, because there's a specific mathematical concept here called proportional sizing that I really want to understand.
Yeah, proportional sizing is key.
Because practically speaking, if I am a retail investor, I might be following a multi-millionaire hedge fund manager or a massive institutional whale.
Right, someone with vastly more capital.
Exactly. I obviously don't have the capital to match their exact dollar amounts. If they buy $10 million of gold, I can't do that. So how does the software translate their massive wealth into my tiny portfolio?
That is exactly where proportional sizing comes in. It is the absolute mathematical engine of the whole copy trading operation.
Okay, walk me through the math.
Let's walk through the mechanics of how this calculates in real time. Let's say you decide to allocate $1,000 of your money to follow a specific, highly successful trader.
Right.
You are not copying their absolute position size. You are copying their relative position size.
Oh, I see.
So imagine that master trader has a $100,000 account. They decide to put 10% of their total equity, which is $10,000, into a single long position on gold.
Okay, so they've committed 10% of their available firepower to this one idea.
Precisely. The moment they execute that trade, the platform's API instantly detects that signal.
Right.
It doesn't look at the $10,000, it looks at the 10% allocation.
Ah, okay.
The software then looks at your account, sees the $1,000 you dedicated to this trader, calculates 10% of your allocated funds, and automatically executes a $100 trade in gold in your account.
So it scales everything down, or scales it up, I guess, to perfectly match the size of my wallet, while keeping the exact same risk profile.
Exactly.
I am dedicating the same percentage of my pie as they are of theirs.
That's the perfect way to look at it.
I like to think of this like water skiing behind a massive high-speed powerboat. You get the incredible thrill, you get the speed, and you don't even have to know how to navigate the waters.
Right, you just hold on.
You just hold onto the rope and let the expert driver pull you along. But here is the terrifying part of that analogy. If that expert driver suddenly gets distracted and violently swerves the boat through a field of jagged rocks, you don't have a steering wheel.
No, you do not.
You are going to get dragged right into those rocks at 60 miles an hour. How exactly do these platforms ensure followers don't get entirely wiped out if a so-called master trader goes completely rogue and drives off a cliff?
That is the most critical vulnerability in the entire system, and it is where the illusion of passive income completely shatters.
So there has to be some kind of safeguard, right?
The answer is that the platforms do build in sophisticated risk management tools to act as a safety net, but, and this is a massive structural but, those tools must be manually configured by the follower.
Wait, automatically copied but manually protected?
Exactly. While the execution of the trades is entirely automated, your risk management cannot be. You have to actively build your own safety net before you hit the copy button.
Okay, what kind of tools are we talking about? How do I build that net? Because if I am asleep and the master trader decides to leverage their entire portfolio on a meme coin at 3 in the morning, how do I protect my $1,000?
The most important tool at your disposal is the manual copy stop loss limit.
Okay, how does that work?
Before you finalize the connection to a trader, you can tell the platform's software, listen, I am allocating $1,000 to this person, but if my allocated equity drops to $800, I don't care what the master trader is doing.
Just cut the cord.
Exactly. Instantly sever the digital tether, unfollow them, and automatically close all open positions at market price. It is a hard circuit breaker.
That makes sense. It's a predefined pain threshold. Once I lose $200, I'm out. regardless of whether the trader thinks the market will bounce back.
Exactly. But there are other granular tools as well. You can enforce forced limits on maximum position sizes.
Like capping how much goes into one trade.
Right. Let's say the master trader is incredibly aggressive and decides to put 50% of their account into a single, highly speculative cryptocurrency trade.
It sounds terrifying.
It is.
Yeah.
Even with proportional sizing, that means 50% of your money, $500, is now tied up in one incredibly risky bet.
Which I might not want.
Right. To prevent that, you can configure your settings to say, never allocate more than 5% of my total funds to any single trade, no matter what percentage the master trader uses.
Oh, that's smart. So even if they go all in, my software overrides the proportion and caps my exposure at a safe level. I'm essentially saying, I'll follow your direction, but not your enthusiasm.
That is a perfect way to phrase it. Additionally, some platforms allow you to dictate a fixed copy amount rather than a purely proportional one.
How is that different?
So instead of matching percentages, you just say, every time this trader buys an asset, I want to buy exactly $50 of that same asset.
Okay, just a flat $50.
Right. If they use 1% of their account, you buy $50. If they use 80% of their account, you still only buy $50.
Wow, so that totally unlinks the sizing.
It decouples your risk entirely from their portfolio sizing and locks it into a predictable flat rate.
So the platform gives you the life jacket, it gives you the helmet, and it gives you the emergency flare gun. But you still have to remember to actually put them on yourself before you get in the boat.
Precisely. The tools are useless if they remain unconfigured in the settings menu. And as we will explore later when we dive into the behavioral psychology of retail investors, human nature almost always ensures that people forget to buckle up.
Because they're just seeing the dollar signs.
Exactly. The excitement of the potential gains entirely blinds them to the necessity of configuring the downside protection.
Man, if the math is this precise and the technology is this instant, I want to take a step back and look at how we even got here. Because an API that instantly mirrors a $1 million hedge fund trade into a retail account in milliseconds didn't just appear out of thin air. There has to be a technological evolution here.
Oh, there absolutely is. It has been a fascinating multi-decade evolution, and understanding it really helps explain why the modern system operates the way it does.
Where did it start?
If we trace the chronological origins back to the early 2000s, the concept of following a professional started with something as rudimentary as email newsletters.
Email, really?
Yeah, a seasoned, successful trader would build up a subscriber base. When they saw an opportunity, they would blast out an email to thousands of subscribers saying, I am entering a long position on the euro against the US dollar right now at this specific price target.
Which, obviously, comes with an absolutely massive latency issue. Imagine the friction there.
Oh, it was terrible.
You have to wait for the email server to deliver the message. You have to happen to be sitting at your computer when the notification pops up. You have to read the rationale, log into your own separate clunky 2003 era brokerage account.
Find the ticker symbol.
Yeah, find the ticker symbol and manually type in the trade order. By the time you do all that, 20 minutes have passed and the market has already moved completely away from the entry point.
Exactly. The execution lag made the strategy almost entirely useless for anything other than very long-term investing. The followers were constantly entering trades at terrible prices compared to the master trader.
So how did they fix that?
So the industry tried to solve this by evolving into virtual chat rooms, like IRC channels.
Oh, right, like the old message boards?
Yeah, a trader would sit in a live chat room and announce a trade the exact second they clicked their mouse. The followers in the room would have their brokerage windows open on a second monitor and would frantically, manually duplicate the trade as fast as humanly possible.
That sounds exhausting. But that still requires the follower to be glued to their screen 24/7. You can't sleep, you can't go to work, you just have to stare at a chat window waiting for a guru to type a ticker symbol.
Precisely. The human bottleneck was still the problem. The real technological breakthrough happened around 2005 with the advent of automated mirror trading systems.
What changed them?
Financial technology companies realized that if they could link the master account and the follower account directly via a back-end API, they could eliminate the human delay entirely.
Oh, taking the human clicking out of it completely.
Exactly. The software could read the master's trade execution and instantly trigger the follower's trade execution in milliseconds. The follower could be asleep, on vacation or at work, and the portfolio would manage itself perfectly in sync with the master.
And that massive technological leap gave birth to what some industry insiders now call people-based portfolios or signal portfolios.
That's a crazy term, right?
It is. And this is the concept that I find most mind-bending. In traditional finance, if you sit down with an advisor, your portfolio is made up of asset classes. You have large cap stocks, you have government bonds, maybe some real estate investment trusts, or physical commodities.
Standard diversification.
Right. But in this new copy trading ecosystem, your primary investment instrument isn't a stock or a bond at all. It's another human being. You are essentially buying shares in a stranger's cognitive decision-making process.
That is a profound paradigm shift. You are entirely outsourcing the analytical burden.
Yeah.
You are no longer betting on the direction of the S&P 500. You are betting on a specific person's ability to navigate the S&P 500.
Which feels super risky.
Well, for a long time, the early academic data actually supported this as a highly viable, superior strategy for retail investors.
Wait, really? The data said it was a good idea.
Yeah. There was a massive landmark academic study conducted in 2012 by researchers at MIT. They gained access to a massive trove of data from early social investment networks to analyze how followers actually performed.
What did they find? Because the prevailing wisdom is always that retail investors get slaughtered when they try to day trade.
The findings were incredibly counterintuitive at the time. The MIT researchers found that retail traders who utilized guided copying, meaning they were systematically copying the moves of a suggested experienced investor, they actually fared 6 to 10% better in their overall returns than traders who were attempting to trade completely manually on their own, relying on their own research.
6 to 10% outperformance is massive over a long time horizon. That's the difference between retiring early and working for another decade.
It is massive. And furthermore, the study found they even fared 4% better than traders who were just randomly copying other investors without a clear strategy.
Wow.
The data seemed to definitively prove that outsourcing your brain to an expert via API was mathematically superior to trying to learn the markets yourself.
Okay, hold on. You're losing me here. I have to push back on this logic.
Go.
You just said that this massive MIT study proved that guided copying objectively outperforms novice manual trading by up to 10%.
That's what the data showed.
But I was looking at several of the largest copy trading platforms just yesterday, and legally, at the very top of their websites, there is a giant bold text risk disclosure mandated by regulators stating that the vast majority of retail accounts, sometimes 70%, 80%, even 85% of users, lose money when trading on their platforms.
Yes.
How can both of those things possibly be true at the same time? If the API perfectly copies a winning strategy, why is the modern D-Day showing a bloodbath?
It is a brilliant contradiction, and unpacking it cuts to the absolute heart of the fatal flaw in copy trading. Later, more nuanced research actually unpacked this exact paradox.
Okay, what did they find?
They found something astonishing. While the individual copy trades are statistically far more likely to produce positive winning returns than standard manual trades, the actual net return on investment, the final ROI that ends up in the user's pocket, is ironically lower for a profitable copy trade than the return of a successful regular trade.
Wait, if the trades win more often, how on earth is the final profit lower?
Yeah.
That defies basic math.
It defies basic math until you introduce the human element back into the equation.
Wow.
It comes down to the practical realities of how users deploy leverage, how they succumb to panic, and the devastating impact of hidden fee structures.
So the study assumed people behave perfectly.
Exactly.
Okay.
The 2012 MIT data assumed a robotic adherence to a strategy. It assumes that if you link your account to a professional trader, you let it run perfectly symmetrically forever without touching it. The master trader takes a loss, you take a loss. The master trader rides a massive win, you ride the massive win.
But humans aren't robots.
Exactly. Real followers constantly manually intervene in the automated process.
Like they pull the plug.
Yeah. They open their app on a Tuesday, they watch their dashboard turn deep red during a temporary, perfectly normal market drawdown. Their heart starts racing, they panic.
And they sell.
And they manually hit the close position button to stop the bleeding, locking in a massive permanent loss before the professional trader's long-term strategy has the time to naturally recover.
Oh, wow.
The professional trader holds the position, the market bounces back on Thursday, and the professional closes it out for a profit. But the follower is already gone.
because they got scared and hit the button?
They effectively break the mathematical symmetry that made the strategy profitable in the first place.
So the platform's API works perfectly, but the user's emotional API is completely broken. They intervene and self-sabotage.
Precisely. And even if they don't panic and they do manage to ride out the winning trades perfectly alongside the master trader, the net ROI is still brutally dragged down by the sheer volume of fees involved in the copy trading ecosystem.
Okay, since you brought up fees, let's follow the money. Because if 80% of retail users are losing money, somebody else is making a fortune.
They certainly are.
Unmasking the fee structures on these platforms is eye-opening. How exactly do the signal providers, the master traders being copied, and the platform providers themselves actually get paid? Who is extracting the wealth here?
It operates on a complex dual fee structure that constantly chips away at the follower's capital. First, you have your standard trading fees.
Just the regular broker stuff.
Right. These are the baseline costs you would pay to a broker, regardless of whether you are copy trading or just trading entirely manually on your own. This includes the spread, which is the fractional difference between the buy price and the sell price of an asset at any given millisecond, and standard broker commissions charged per execution.
Right. The broker always takes their cut of the transaction volume. It's the toll booth on the highway. Every time you pass through, they take a few cents.
Always. That is how brokerages keep the lights on. But in copy trading, on top of that standard toll booth, you have the performance fees.
Okay, this is the master trader's cut.
This is the mechanism by which the signal provider, the master trader, gets compensated for allowing you to copy their intellectual property. Typically, the platform automatically deducts between 5% and 30% of the profits generated for the follower and passes that cash directly along to the trader you are copying.
Wait, so if I hit a big win, they take up to 30% of my upside. Does the platform just automatically skim that from my brokerage account at midnight?
Essentially, yes. The accounting is entirely automated on the back end. When a profitable trade is closed, the platform calculates the net gain, slices off the master trader's 20% or 30% performance fee, takes a small administrative cut for themselves, deposits the rest in your account, and sends the fee to the master trader's wallet.
Okay, but what if they lose my money? If they go on a terrible losing streak, I'm obviously not paying them a performance fee, right?
Correct. You only pay a performance fee on positive returns. But the mechanics of when you pay that fee are governed by a crucial, mathematically complex concept called the high watermark principle.
Let's explain this in plain English, because anyone putting a single dollar into a social trading app needs to understand exactly how the high watermark dictates their wealth. Let's trace an exact user journey. Let's invent a user. Let's call him Alex. Walk me through Alex's exact experience with this fee structure over a few months.
Absolutely. The high watermark is designed to ensure that performance fees are only ever charged on new net profits, so you aren't paying a master trader for simply recovering money they previously lost for you.
Okay, so month one.
Let's say Alex opens an account and allocates exactly $5,000 to follow a top-ranked trader. In month one, the master trader has an incredible run. Alex's account grows from $5,000 to $6,000.
Okay, so Alex has exactly $1,000 in gross profit.
Yes. Because that $1,000 is entirely new profit, the platform applies the performance fee. Let's say the fee is 20%.
Okay. The platform deducts $200, sends it to the master trader, and Alex keeps $800. Now, and this is the vital part, Alex's high watermark is permanently set at $6,000. That is the new baseline peak.
Got it. The tide came in, it hit the $6,000 line on the dock, and left a mark.
Exactly. Now let's look at month two. The market turns volatile, the master trader's strategy fails, and Alex's account balance plummets from $6,000 down to $4,500.
Ouch.
Yeah. He is now sitting on a net loss compared to his initial investment. During month two, because there are no new profits, Alex pays 0 performance fees.
Obviously. You can't charge a fee on a massive loss.
Right. Now we enter month three. The master trader gets their act together, the market recovers, and Alex's account climbs out of the hole, moving from $4,500 back up to $5,800. He just made $1,300 in profit during month three.
Oh, okay. So does the platform take 20% of that $1,300? No. And this is the beauty of the high watermark. Because Alex's current account balance of $5,800 is still strictly below his historical peak, his high water mark of $6,000,
Wow.
he does not pay a single cent in performance fees on that $1,300 recovery.
Oh, wow.
The master trader is essentially working for free to dig Alex out of the hole they put him in. Alex will only start paying performance fees again the exact moment his account balance surpasses that $6,000 peak and breaks into new territory.
Honestly, that sounds incredibly equitable. It stops the platform from double dipping. You don't pay fees on the same money twice just because the account is violently swinging up and down.
In theory, it is the fairest way to structure a performance contract. But while the high water mark protects you from double paying the performance fee, it does absolutely nothing to protect you from the hidden transactional costs that constantly, silently chip away at your underlying equity.
Because there are always more fees.
To understand why ROI is so low, we have to walk through the microscopic math of a specific scenario. Let's imagine a follower theoretically gains exactly $1,000 in gross profit from a copy trading strategy over a month.
Awesome. The dashboard says I'm up $1,000.
The dashboard says that, but your bank account will tell a very different story. First, let's subtract the profit-sharing fee we just discussed. Let's use a conservative 10% fee. That is $100 gone instantly. Your $1,000 profit is now $900.
Okay.
Now, over the course of the month, to generate that $1,000, let's assume the master trader executed 50 separate trades. Every single time the API copied a trade, the platform charged a small spread or a commission. Let's say that averages out to $1 per trade. That is another $50 gone.
Okay, so my $1,000 is down to $850. Still not terrible.
Next, we have to account for overnight funding costs, also known as swap rates.
What are those?
If the master trader is utilizing leverage, which almost all of them do, meaning they are borrowing money from the broker to artificially amplify the size of their trade, and they hold those positions open past 5 p.m. New York time, the broker charges a daily interest rate for lending that money.
Right, because it's a loan.
If a position is held for weeks, those daily interest charges compound. Let's say over 50 trades. Those overnight fees cost you $30.
So my original $1,000 profit is now whittled down to $820. But honestly, if I did absolutely zero work and I still netted $820, I'm still thrilled.
You would be. Until you introduce the truly invisible costs. The silent killers that aren't cleanly itemized on your monthly statement slippage, latency lag, and foreign exchange conversion fees.
Oh boy. Let's talk about slippage and latency, because this is a mechanical reality of the internet.
It is. The master trader clicks buy in London. That signal has to travel via fiber optic cables to the platform's central servers, process the proportional sizing math, and then travel to your broker server in New York to execute your trade. That takes time.
Even just a fraction of a second.
It might only be 200 milliseconds, but in highly liquid, volatile markets, high-frequency algorithms are executing thousands of trades in that exact same 200 milliseconds.
So the price of the asset is physically changing while the signal is literally flying across the Atlantic Ocean.
Exactly. By the time your order actually hits the market book, the price has moved. That 1 second or half-second delay almost guarantees you are entering the trade at a slightly worse price than the professional trader did.
So they get the perfect price, and I get what's left.
They bought the bottom, you bought slightly above the bottom. Over 50 trades, that slippage adds up to a massive drag on your portfolio. And finally, if you deposited your funds in euros, but the master trader is executing trades settled in US dollars or Japanese yen, the platform is quietly hitting you with hidden FX conversion spreads on the back end of every single trade to swap your currency back and forth.
So when we add up the performance fee, the commissions, the spreads, the overnight interest, the latency slippage, and the currency conversion, what does this all actually mean? How drastically do these compounding microtransactions alter the reality of what a user sees advertised on a master trader's glossy leaderboard profile versus what actually ends up in the follower's bank account?
The quantitative analysis shows that real net returns are routinely 10% to 15% lower than the gross profits advertised on the leaderboard.
10 to 15%. That's huge.
And this mathematical reality exposes a massive trap when it comes to choosing different trading styles. Think about high-frequency traders, scalpers.
Scalpers.
These are traders who are making dozens, sometimes hundreds of tiny rapid-fire trades every single day. They're trying to capture micro movements in the market, making maybe a few dollars per trade.
Right. If you look at their profile, they're gross profit chart looks incredible.
Oh.
It's just a beautiful 45-degree angle staircase steadily moving up. It looks like the safest, most consistent strategy in the world.
On paper, for their own account, it might be. But for a follower, copying a high-frequency scalper is financial suicide.
Because of the fees.
Exactly. The master trader is executing hundreds of trades to make a tiny gross profit. But the follower is absorbing the spread cost, the commission, and the latency slippage on every single one of those hundreds of tiny executions.
Oh, wow.
The sheer volume of the transaction fees will absolutely mathematically gut the follower's actual net yield, turning a winning master strategy into a steadily bleeding follower account.
That is a staggering blind spot. You look at a leaderboard, you see a guy making consistent money every day, but you don't realize his specific high-volume scalping strategy is fundamentally incompatible with the latency and fee structure of your specific follower account. The friction burns up all the fuel.
Exactly. The friction destroys the profit.
Which leads us seamlessly into the core risks of copy trading, because the dangers go so much deeper than just the fees. Let's talk about trader and strategy risks, and specifically, I want to unpack this incredible illusion of the 95% win rate, because I see this advertised everywhere.
It is undoubtedly one of the most dangerous and predatory psychological traps on these platforms.
How does it trap people?
Imagine a novice retail investor logs onto a social trading app for the first time. They don't know anything about finance. What do? They go to the search filter, they sort the leaderboard by highest win rate, and they find a trader who boasts that they win 95 out of every 100 trades they take.
Yeah, that seems like the logical thing to do.
To a novice, that doesn't just look like a good strategy. It looks like a mathematically guaranteed sure thing.
It looks like free money.
Yeah.
If a guy wins 95% of the time, how can I possibly lose by following him? Explain the illusion to me.
The illusion exists because win rate, as an isolated metric, tells you absolutely nothing about the underlying risk-to-reward ratio of the strategy.
Okay, walk me through that.
Let's walk through the math of how a trader can easily manufacture and maintain a massive 95% win rate while deploying a fundamentally terrible, doomed strategy. Imagine a master trader opens a position. The absolute second that trade goes into the green, maybe it's only up by $1, they immediately close the trade and lock in the win.
Okay, so taking tiny, tiny profits.
They do this 95 times in a row. They have 95 winning trades, and they have made exactly $95. Their win rate is a flawless 100% at this point.
Okay, but what happens when a trade goes wrong? Because the market doesn't always go up.
Exactly. When a trade goes against them, they refuse to close it. They refuse to take the loss and ruin their perfect win rate.
Oh, no.
So they let the open position float in the red, down $10, down $50, down $100, just praying and hoping that the market will eventually turn around so they can close it for a $1 profit.
That's agonizing.
Let's say over the month, they have 5 of these catastrophic trades that they refuse to close, and eventually the broker forces them to close at a $100 loss each.
So let me do the math. They won 95 trades, making $95, but they lost 5 trades, losing $500. So they are technically winning 95% of the time. Their profile has a shiny gold badge on it, but they just wiped out their entire portfolio and bled hundreds of dollars on the 5% of trades they lost.
Precisely. It is an asymmetric risk profile skewed entirely toward catastrophic ruin. And the data reflects this grim reality explicitly.
What does the data show?
Studies show that over 35% of the absolute highest performing, top-ranked social traders experience massive account liquidating losses in the following quarter.
35%, that's insane.
Their reckless, asymmetric strategies are temporarily masked by a short-term lucky streak of markets moving in their favor, but the underlying mathematical mechanics guarantee their eventual ruin.
It is the ultimate illusion of safety. Maintaining a 95% win rate by holding on to massive, bleeding, losing trades is like a restaurant bragging about having 95 consecutive days of perfect health inspection scores, but intentionally hiding the fact that on day 96, they served bad chicken and gave the entire dining room salmonella.
That is a phenomenal analogy.
The average score over the quarter looks fantastic on the front door, but the ruin experienced by the people inside is catastrophic and permanent.
The catastrophic event entirely negates the track record, and the risk of this ruin is heavily compounded by something called overexposure.
Putting all your eggs in one basket.
Basically, the data shows that relying on a single master trader or even a single specific strategy results in up to 40% more portfolio volatility than maintaining a diversified approach across different asset classes. If you give all your money to the guy who serves the bad chicken, your entire portfolio dies with him.
And here's the scariest part. Even if you do your due diligence and you find a genuinely great trader with a responsible risk-to-reward ratio, you still have to worry about external market and execution risks.
Yes, you can't control the market.
The platform isn't operating in a clean mathematical vacuum. The real world intervenes. Let's talk about systemic risk and liquidity risk.
Right. Systemic risk involves black swan events. These are massive, unpredictable global shocks that crash entire markets simultaneously, regardless of how good your master trader is.
Like what?
Think of sudden geopolitical conflicts, unannounced central bank rate hikes, or global pandemics. If you are copying a trader who operates in inherently volatile markets, like emerging market forex currencies or exotic cryptocurrencies, a sudden global event can gap the market down so violently and so fast that your carefully configured manual stop-loss orders are completely bypassed.
They bypass.
The price plummets past your safety net before the system can even trigger the sell order.
What about liquidity risk? I feel like this is a mechanical concept that retail investors almost never think about until they are hopelessly trapped in it.
It is terrifying when it materializes. People assume that because there is a sell button on their app, they can always turn their digital asset back into cold, hard cash instantly. But markets require a buyer for every seller. Let's say the master trader you are copying enters a massive position on an exotic, thinly traded currency pair, say the South African rand, traded against the Turkish lira. Or maybe they buy into a low-volume, obscure microcap stock. Suddenly, bad news breaks. A market crisis hits that specific asset and trading volume evaporates.
Everyone wants out, but nobody wants in.
Exactly. The master trader panics and tries to exit the position. The API sends the signal to your account to sell. But when your order hits the market, there are literally no buyers on the other side of the order book willing to take the asset at any price.
So you're stuck.
The order book is empty, the asset completely freezes, the follower is now trapped, holding a rapidly depreciating toxic asset with absolutely zero exit liquidity. It is like trying to sell a house in a town where the only factory just closed. It doesn't matter what you list the price at, nobody's buying.
Which brings us to the ultimate multiplier of all these risks we've discussed, leverage. You mentioned it earlier, but I want to deeply understand the mechanics here. Because leverage seems to be the gasoline poured over the entire copy trading ecosystem.
Leverage is the absolute accelerator of both wealth and ruin. In the copy trading space, signal providers frequently use extreme, almost incomprehensible leverage ratios. We were talking about ratios of 1 to 100 or even 1 to 500 offered by offshore brokers.
Okay, break the math down for me viscerally. What does 1 to 500 actually mean for the money in my account?
It means you are trading with borrowed money on a massive scale. If you have a $100 account and you use 1 to 500 leverage, the broker is spotting you $50,000 of their money to artificially amplify the size of your trade.
Wow.
You are now controlling a $50,000 position in the market with only $100 of your own actual cash acting as the collateral.
So if the asset price moves up by just 1%, I don't just make a 1% gain on my $100. I make 1% on 50 grand. It's a $500 profit. I just quintupled my money on a tiny market movement. That sounds incredible.
It is incredible on the way up, but the blade cuts infinitely sharper on the way down.
Let's hear the downside math.
Let's do the math on the downside. If you are controlling a $50,000 position and the asset price drops by just 0.2%, 0.2%, you haven't just lost a fraction of your trade. Your loss is now $100. Your entire actual account balance has instantly evaporated.
And what happens mechanically at that exact millisecond?
The broker issues a margin call. The broker is not going to risk losing their $50,000 just because you made a bad bet.
So they take it back.
The absolute second your $100 of collateral is wiped out by that 0.2% micro fluctuation, the broker's automated risk engine steps in, seizes control of your account, and instantly auto-sells your position at a loss to protect their loaned capital.
You're done.
You are completely liquidated. And this is why followers must cap their own exposure. If a master trader has a $10 million account and makes a 1 to 500 leverage trade, they have massive capital reserves to act as a buffer against tiny market dips.
They can survive the little bumps.
But if you blindly replicate that exact same leveraged trade with your tiny $500 account, a micro fluctuation in the asset's price, a tiny dip that the master trader can comfortably absorb without getting liquidated, will trigger an instantaneous margin call in your smaller account, permanently wiping you out before the asset even has a chance to bounce back and become profitable.
That is genuinely terrifying. If the underlying math is this stacked against the follower, if the execution lag is gutting their returns, and if leverage is a ticking time bomb, why are millions of people still logging onto these platforms every single day?
It's all about the psychology.
There has to be a psychological hook here that overrides rational math. Let's explore the behavioral psychology and the algorithmic opacity of these networks, because there is a profound irony at play here regarding who is actually attracted to this ecosystem.
It is one of the most studied paradoxes in modern financial behavior. It is the irony of risk aversion.
What does that mean?
If you asked a rational person to describe the type of individual who would hand their money over to an anonymous stranger on the internet executing 1 to 500 leveraged crypto trades, you would assume it attracts reckless adrenaline junkie gamblers.
Right, the Vegas crowd.
But extensive behavioral studies reveal the exact opposite is true.
Who is actually doing this then?
The demographic data shows that individuals with inherently low risk tolerance, people who are deeply intimidated by the stock market, who are terrified of analyzing complex financial charts, and who lack the confidence to make their own independent trading decisions, are by far the most likely to be drawn into copy trading.
That is so backwards.
They feel inadequate, so they actively seek out the perceived safety net of a designated expert.
I see. The internal monologue is, I have no idea what I'm doing. I don't understand these charts, so I will just give my money to the guy with the gold badge and the 95% win rate because he obviously knows exactly what he's doing. It's a desire for safety, not a desire for a casino.
Exactly. It is a surrender of agency in exchange for perceived security. But here is the deeply tragic psychological twist. Once these inherently conservative individuals are securely inside the ecosystem, shielded by the powerful illusion that a seasoned professional is sitting at the wheel, their behavior radically changes.
How so?
The platform gives them a false sense of invincibility. It overrides their natural biological risk aversion. And as a result, these cautious people are slowly tempted into taking on far greater financial risks, like allocating large portions of their net worth to highly leveraged, incredibly volatile foreign exchange strategies than they ever would have even considered if they were forcing themselves to execute the trades manually.
Oh, wow.
The presence of the master trader acts as a psychological anesthetic against risk.
And the platforms themselves are not innocent bystanders in this psychological transformation.
Yeah.
They're actively encouraging and accelerating this behavior through their user interface design.
Oh, heavily.
We are talking about the aggressive gamification of complex finance. These apps use the exact same psychological hooks as mobile video games or social media feeds.
Notifications everywhere.
Right, you get bright push notifications pinging your phone every time a trade closes. You unlock digital achievement badges for hitting certain trading volume milestones. And you have these massive scrolling leaderboards that look exactly like a competitive video game high score screen. But perhaps the most dangerous UI simplification of all is how they handle risk assessment. How exactly do these platforms condense a trader's complex history into those little 1 to 10 risk score labels you see next to their names?
That 1 to 10 risk score is an absolute masterpiece of dangerous, misleading oversimplification. Consider what makes a strategy risky. You have to analyze historical drawdowns, you have to look at how much leverage they utilize, you need to understand their portfolio concentration across sectors, and you have to measure the inherent volatility of the underlying asset classes they trade.
Right, that's a complex, multivariable equation that requires deep financial literacy to interpret.
Precisely. But a platform doesn't want its users to be intimidated by complex equations because friction stops them from depositing funds.
So they dumb it down?
So the platform takes all of those complex, vital metrics, runs them through a proprietary formula, and compresses it all into a single, easily digestible digit from 1 to 10. They tell the user, a score of 3 is safe, a score of 9 is risky, choose your comfort level. It entirely strips away all the necessary nuance and context that an investor actually needs to make an informed, rational decision about their wealth.
A risk score of 10. What does that even mean in reality? Is it 10 just a slightly volatile tech stock, or is it 10 a guy literally trading meme coins with his mortgage money while using 500x leverage? The number tells you nothing about the mechanism of the risk.
Nothing at all.
And it feeds directly into this broader concept that researchers call algorithmic opacity.
Yeah.
Ground that high-level academic term in plain English for me. What does algorithmic opacity actually mean for the average user opening the app?
Algorithmic opacity simply means that the engine running the platform is a deliberate black box. When you log onto a platform, the very first thing you see is a top traders or recommended to follow leaderboard.
Right.
But the exact mathematical criteria the platform uses to rank those traders and push them to the top of your screen is almost always a strictly guarded proprietary secret.
So we have no idea how they are grading these people. We don't know if the algorithm is heavily weighting a trader who had massive lucky success over the last 72 hours versus a trader who has shown slow, boring, stable growth over the last 5 years.
Exactly. And because the algorithm is opaque, its impact on the real-world market is profound and often highly destructive. This opaque ranking system essentially funnels massive concentrated amounts of retail capital. We are talking tens of millions of dollars toward a very small handful of highly visible traders who happen to game the algorithm and reach the top of the list.
Wait, let me follow the logical conclusion of that. If a platform's proprietary secret algorithm artificially directs 50,000 followers, who collectively represent $50 million in capital, to automatically copy one specific momentum trader, aren't they essentially manufacturing an artificial bubble in whatever obscure asset that master trader decides to buy?
That's exactly what happens.
Let's say the master trader buys a thinly traded microcap stock. A millisecond later, the platform's API forces 50,000 followers to instantly execute market buy orders for that exact same obscure stock. The massive sudden surge in demand rockets the price of the stock upward instantly. The master trader looks like a genius because the asset spiked, but it only spiked because his followers were forced to buy it. It's a completely self-fulfilling prophecy.
It absolutely is, and what you just described is known in the data as systemic herding behavior. It exposes an incredible, terrifying systemic fragility in the modern market structure.
So by systemic herding, you just mean the platform's algorithm accidentally creates a giant coordinated financial flash mob that artificially manipulates the price of an asset.
That is the perfect analogy. It is a financial flash mob entirely coordinated by a blind algorithm. And expensive experimental evidence proves that this specific environment, featuring frictionless one-click copying, combined with prominent algorithmic leaderboards, directly and measurably increases the overall market risk appetite of everyone involved.
It's feeding a frenzy.
Furthermore, the historical data shows that generating the massive, short-term high returns required to climb to the top of that opaque leaderboard usually correlates directly with extreme, reckless risk-taking by the master trader.
Meaning, the algorithm is systematically incentivizing and actively rewarding the followers to copy the absolute most reckless actors on the entire platform simply because those actors, flip a coin, had a lucky, highly leveraged week, and the algorithm temporarily pushed them to the top of the rankings.
Yes. It is an engine meticulously designed to reward unsustainable, reckless behavior and then amplify that behavior with a massive herd of blind followers, inflating artificial bubbles that eventually and inevitably burst, wiping out the retail capital at the bottom of the pyramid.
That is genuinely terrifying. It is a machine building its own destruction. Which leads us to the final, inevitable phase of this story, the regulatory crackdown and the future of platforms. Because obviously, if billions of dollars of retail capital are being vaporized by opaque algorithms and 500x leverage, the adults in the room at the government level have finally noticed what is going on.
They certainly have, and their intervention is currently reshaping the entire industry. For a very long time, the early era of copy trading existed in a deeply ambiguous legal gray area.
Because it was new tech.
The platforms essentially hid behind their technology. They aggressively claimed they were merely neutral software providers. Their legal argument was essentially, we do not provide financial advice. We do not manage money. We simply provide the API software pipes that allow user A to connect to user B. What they do through those pipes is entirely their own responsibility.
The classic tech company defense. We're just the platform, not the publisher. But I imagine financial regulators don't look too kindly on that argument when retail life savings are evaporating.
They do not. Global financial regulators, particularly the FCA in the United Kingdom and ESMA, which is the European Securities and Markets Authority, have stepped in and fundamentally shifted the legal definitions of what these platforms actually are. They have entirely rejected the neutral technology defense.
How so? What exactly did they change?
Regulators have formally declared that providing automatic trade execution with no manual input from the follower is legally classified as a form of portfolio management or discretionary investment management. It is no longer legally considered just a convenient tech feature.
Okay, so legally, the regulatory bodies are saying the platform isn't just a software company anymore. They are now legally viewed as active asset managers, subject to the exact same laws as a traditional wealth management firm on Wall Street. What does that reclassification actually mean for how these platforms are forced to operate day to day?
It introduces a wave of incredibly strict new operational requirements, the most significant and disruptive being the mandate for suitability and appropriateness assessments. Under the old system, a novice could deposit funds and instantly click copy on the most aggressive crypto trader on the site. Under the new regulatory framework, platforms can no longer just let anyone copy anyone.
They have to build friction back into the system.
Exactly. Before a user is allowed to execute a copy connection, the platform is legally mandated to gather comprehensive, detailed data on that user. They must administer extensive questionnaires to assess the user's actual financial situation, their true risk tolerance, their annual income, and their specific knowledge of complex financial instruments.
So if I'm a retail investor and my profile assessment reveals that I am a low-income novice looking for slow, safe, long-term growth for my retirement, and I try to hit the copy button on a master trader who uses 1 to 500 leverage to day trade exotic currencies, what happens?
The platform's software must legally intervene and block you from executing that connection. They are legally required to prevent the action because the underlying strategy of the master trader fundamentally violates the suitability profile you provided.
That is a massive shift. They have to actively stop you from doing something stupid to protect themselves from regulatory fines.
Exactly. The master strategy must mathematically fit the follower's profile. Additionally, regulators are aggressively cracking down on remuneration rules, how the money flows behind the scenes. Platforms must meticulously ensure that the specific way they pay signal providers doesn't create a toxic conflict of interest. For example, regulators are moving to ban volume rebates.
What is a volume rebate and why is it toxic?
A volume rebate is when a platform pays a master trader a small kickback fee strictly based on the sheer number of trades they execute, rather than the profit they generate.
Oh, I see where this is going.
If a platform uses volume rebates, they are perversely incentivizing the master trader to overtrade, to constantly open and close positions rapidly all day long, not to make money, but purely to farm execution fees and kickbacks from the thousands of followers copying every single one of those meaningless trades. Regulators are forcing platforms to prove their fee structures do not encourage this kind of predatory churning.
If the regulators are now definitively stating that this entire ecosystem is a form of discretionary portfolio management, that raises a massive lingering question about the master traders themselves.
What's that?
If these individual signal providers, some guy sitting in his basement in his pajamas, are now essentially acting as unregistered hedge fund managers for thousands of people, sometimes collectively managing tens of millions of dollars of follower equity, what personal legal liabilities do they face? Can they be sued if they blow up an account?
This is where the landscape gets incredibly precarious for the signal providers. This is governed by regulations like the Market Abuse Regulation, or MAR, in Europe.
Okay.
If a signal provider publicly presents themselves as having financial expertise, builds a massive following, and their daily actions act as a de facto portfolio manager for thousands of retail investors, they cross a legal threshold. They are now subject to stringent transparency and disclosure rules.
They can't just hide anymore.
Right. They can no longer just trade however they want in total secrecy without oversight. They cannot engage in market manipulation like pump and dump schemes using their followers as the artificial demand.
And who is responsible for catching them if they do?
The burden falls heavily on the platforms. The platforms must actively police the qualifications, the communications, and the trading behaviors of these master traders. If a master trader uses their followers to artificially inflate a microcap stock, the regulator will punish the platform for allowing it to happen.
So the platform is on the hook.
This fundamentally shifts the platform's role from a hands-off neutral tech provider to an active, legally liable financial supervisor. They are entirely responsible for ensuring the broader market isn't being manipulated by their own top users.
It sounds like the Wild West era of social trading, the era of unregulated, highly leveraged, gamified free-for-alls, is rapidly and permanently coming to a close.
It absolutely is. The barrier to entry for operators in this space is getting exponentially higher. The legal compliance costs are skyrocketing, and the algorithmic opacity is being systematically dismantled. But ultimately, this is a necessary and long overdue evolution for the protection of retail capital.
Okay, let's bring this all together. We have covered a massive amount of highly complex ground today, from API latency to European regulatory frameworks. If you are sitting there listening to this and you have $500 sitting in a social trading app right now, or you are thinking about opening an account, here are the 3 absolute core takeaways from our deep dive into the true mechanics of copy trading.
Number 1 being the analytical burden.
Right. First, copy trading absolutely shifts the analytical burden to a third party. You don't have to read the charts. But in exchange, it vastly increases the vital need for rigorous manual risk management and portfolio diversification on your part. You can easily automate the execution of the trade, but you can never, ever automate the risk assessment.
That's completely true. And the second takeaway is all about the fees.
Yes, remember, the profit paradox, gross profits advertised on leaderboards, are a deliberate illusion. The net returns you actually see in your bank account are strictly dictated by the underlying friction, the fee structure, the latency slippage, the high watermark rules, and the hidden, devastating compounding costs of leverage and high-frequency trading.
The friction will eat you alive if you're not paying attention.
Exactly. And third, global regulators are actively eliminating the Wild West of social trading by legally reclassifying these platforms as active portfolio managers. They're forcing strict suitability limits on retail investors to prevent systemic herding, algorithmic manipulation, and catastrophic leverage wipeouts.
And that summary leads us perfectly to the one question.
Okay, what is it?
The most actionable piece of advice we can offer. If you are interacting with this space, if you are staring at a glossy profile of a trader with a 95% win rate, this is the single most vital question you must ask yourself and actively research before you ever link your account. What is the maximum historical drawdown of the trader I am following, and exactly how does the platform compensate them?
Break that down. Why does that specific combination of past failure and current financial incentive matter so much more than their win rate?
Because a master trader's personal psychological appetite for catastrophic risk, combined with their specific financial incentive to overtrade for volume kickbacks, will instantaneously become your exact, literal financial reality the absolute millisecond you hit the copy button.
That's sobering.
If they are incentivized to churn, they will churn your account to zero. If they have survived a 60% drawdown in the past, you must be mathematically and emotionally prepared to lose 60% of your money tomorrow.
It always comes back to understanding the invisible incentives. I want to leave you with one final provocative thought to mull over as we wrap up. We spent this time talking about how this ecosystem started with slow email chat rooms and evolved into humans using APIs to instantly copy other humans. But as platforms continue to ruthlessly automate and as quantitative AI models become increasingly sophisticated and accessible, they are beginning to replace human signal providers entirely. Copy trading may very soon cross a new threshold.
AI copying AI.
Exactly. It may become algorithms endlessly copying other algorithms. When human sentiment and human panic are entirely removed from the equation, and millions of retail accounts are instantly mirroring the exact same machine-generated trades at the speed of light, acting as a massive unified swarm. What happens to global market liquidity the moment that centralized master algorithm makes a single catastrophic miscalculation?
It could be devastating.
If you are water skiing behind a professional boat driver and they hit the rocks, it is a personal tragedy. If you are tethered to a centralized AI that suddenly decides to drag 1 million followers into an empty order book simultaneously, well, that's not just a crash. That is a systemic market failure that could freeze the entire global exchange. Keep your hands firmly on the wheel and manage your own risk.